Welcome to yet another episode of The Big Picture. In the last episode, we spoke about the West Asian crisis and the impact on Indian economy, specifically the currency, the current account deficits, the balance of payments, and the likes. So this time, today, we try to quantify and try to look at what options the government of India has to tide over this crisis. Over the last 3 years, 2024, 2025 and 2026, India has been importing petrol, oil and lubricants. POL imports has been in the range of approximately about 100 to 110 billion dollars. We're talking about net imports. Imports less exports, because there are refineries which are importing and re-exporting. So given this 100 to 110 billion dollars, if you look at the current oil prices, which are higher by about 35 to 40%, depending on the period you consider from the past, this bill is going to be higher by at least 35 to 40 billion dollars. Till the time the war, or rather the supply chain constraints remain, which means that there is a requirement of approximately $3 billion every month just to pay for this, the additional dollars required on account of higher oil prices. See, we are ignoring the possible impact of higher transportation, higher insurance and the related stuff. We are limiting this discussion to just oil, petrol, oil and lubricants. There are additional factors like, when we look at the amounts required for importing urea, importing other petroleum derivatives for other purposes. Just focusing on, when we look at these factors, when we look at just petrol, oil and lubricant, we need $3 billion monthly. On the other side, we see that foreign investors have been leaving India, particularly the equity investors. The FDI investors are not really particularly gung-ho about India at the moment. So we are facing two issues. One, requirement of higher dollars to pay for this higher petroleum bill, and a requirement to pay dollars for those investors who are exiting India. So some of the suggestions, some of the reports that we read talks about a similarity comparing today versus what happened in 2013 around, August, September 2013. So August, September 2013 was characterized by what is termed as taper tantrums. So there was, as a response to the crisis in 2008, the global central banks went in a path called quantitative easing. So the taper tantrum was in a way of withdrawal of quantitative easing. It's a form of quantitative tightening, which kind of made the rates go up slightly, and investors withdrew money because economically it made sense to invest in markets where rates were better, where yields could be higher. Now what really happened was, because this was a global event, this was again a monetary policy decision by the US Federal Reserve, many of the central banks came together and offered each other swap lines, which meant that you could get dollars and kind of pay those existing investors without affecting the currency in a big way. Although Indian INR depreciated significantly in that short period of 2 months. Now, are we in a similar situation today? The answer is clearly no. Two reasons. One, this is not a global monetary policy event. This is more of an event driven by geopolitics and supply chain issues. Two, the interest rates. So 2013, when you look at what was the interest rate in the US, so the shorter rates, let's say 3-year rates were about 0.5%, whereas the longer tenor, the 10-year rates were close to about 2.5%. Today, the short term, the 3-year rates are close to 4%, and the 10-year rates are closer to slightly in the range of 4.5%. So there is a significant increase. The shorter rates have gone up by almost 3.5%, and the long end is almost up by 2%. If India is trying to do, government of India or RBI is trying to raise money from NRIs that way they did, where the FCNRB deposits were raised and banks that raised those deposits were given a concessional swap rate to manage their currency risk. If a repeat of that would mean that the cost of raising that fund is significantly higher. So there are a lot of reports. If you read back the impact of the plan of 2013, the total cost or the real cost was expected to be around 8% in INR terms. After this, the borrowing from, the NRIs depositing money in dollars and the cost of the swap rates. So if you put these things together, it was expected about 7.5 to 8%. Now, if you have to pay more today and then add on top of it the cost of hedging costs and the related things, the cost of doing this, repeating that scheme today, could be north of 10% in INR terms, whereas on the domestic market, government of India continues to borrow at about 7%. Now, and second thing is, this is going to be till the time the war or the supply chain disruption continues. This issue is going to last for us, which means that the requirement of dollars could be much longer. So what could the government do? Let's look at a couple of options. So 3 months ago, in January or December of last year or before the war, we were paying $70 per barrel of crude, and the producing nation was happy with that price, right? So today, let's get into an agreement. Let's see if they are open. The producing nations are open to an agreement where we continue to pay $70 today, and we pay the rest as an IOU over let's say 3 years later or 2 years later, or maybe over a period of time. Now, the issue here is that whichever way you look at it, because equity inflows are not happening, you need to raise money some form. In 2013, you raised money from NRIs. This time, you are raising money from those supplying oil to you. Now, could it work? Maybe, maybe not. But if you really look into the history, when Japan was exporting to US, Japan was the biggest investor in US dollar bonds. Later, when China was the biggest exporter to US, China was one of the biggest investors in US bonds. Now, this whole idea of where the supplying nation, the exporting nation invests in the bonds of the importing nation is nothing new. It's something that has happened over if you see the history of trade, it has happened. Now, this is something for the government of India to maybe think about, maybe work, and that's where our diplomatic efforts comes into play. Maybe UAE may be willing to do that, maybe nations, maybe US may be willing to do that, maybe Nigeria or maybe Norway will be willing to do that. But at some point, the crux of the matter here is India has to issue dollar denominated bonds or dollar denominated debt to raise this money. While in 2013 it was to NRIs, in 2026 it could be to the countries which are exporting oil to you. The key difference is between China, Japan and India is, while it was a competitive market on a discretionary basis, oil is not a discretionary, oil is a non-discretionary asset. Oil is a non-discretionary material, a global commodity. We'll see you soon with yet another episode of The Big Picture. Thank you.
Investment in securities market is subject to market risks. Read all the related documents carefully before investing.